Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get more on UMich. So it's really that one-year inflation expectation falling to 2.7%, the lowest since December 2020. Joanne Hsu is University of Michigan Surveys of Consumer Director, and she joins us now. Walk us through the increase in sentiment and the decline in those one-year inflation expectations.
Consumers actually now have had several months of general improvements in how they feel about the economy. Clearly the drop in one-year inflation expectations is a huge part of it. Consumers are 100% aware and have noticed that inflation has slowed down quite a bit, not just this year, but over the course of the last 2 years. And consumers are starting to feel a bit more optimistic about the future. With one-year business conditions, we've had 4 or 5 consecutive months of increases at this point. I think they are recovering a bit from the malaise that we were seeing earlier in the summer.
So the headline, Joanne, came in at UMich sentiment 69 versus consensus of 68.5 and 67.9 last period. Can you frame that? Give us a sense of context there. Like, for example, for ISM, above 50s means economies are expanding, below 50 means it's contracting. What does a number of 69 mean to you? Put that in context for us, please.
So overall, it's still below the historical average that we've seen since 1978. But I think what's more important than just the number itself is the overall trend. And now we've had 2 consecutive months of increases in sentiment. We're at the highest level since in several months now. And so, I think the thing to note is that consumers are starting to feel a bit more upbeat, and that's the upward trend that we've been seeing.
How does it go on party lines, Republican versus Democrat? Because is this the first survey that really encapsulates Biden out, Harris in?
Yeah, we saw a bit of that at the with the August reading, and we saw kind of a continuation of that. So it's very clear that Democrats are seeing, both Democrats and Republicans are now increasingly expecting a Harris win, relative to last month and certainly relative to when it was Biden versus Trump. Now, Democrats think that's a good thing, and we see that in their economic expectations. It really surged in August, and we were continuing to see, this higher level in September as well. Republicans, on the other hand, think that the potential of a Harris presidency is bad news, and their sentiment, their expectations have declined. And so we saw a widening of the normal partisan gap in August, with Democrats improving, but that was offset by Republicans getting worse. And we saw a little bit more of that, not as dramatic as last month, but that partisan gap is continuing to widen.
All right, thanks so much. Really appreciate it, Joanne. Joanne Hsu, University of Michigan Surveys of Consumers Director, joining us there on UMich, slowly grinding its way higher, and at that one-year inflation expectation falling as well.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, let's go to our friends at Boeing here. I mean, stock down 2.7%. They got a strike up there in that Pacific Northwest region of the world, which is where they are generally based. I think the heart and soul is certainly there. George Ferguson joins us. He's a Bloomberg Intelligence Senior Aerospace Analyst for Bloomberg Intelligence. George, how is it? So we've got a strike affecting Boeing up there in the Seattle area. How impactful is this strike to them? What do they need to do?
Yeah, so it's super impactful, right? Because it's on their 737 MAX. I mean, it's going to be on the programs that are out of the Pacific Northwest, I should say. First, which are going to be 767, 777, and the 737 MAX. The 737 MAX is what matters most, right? That's the revenue generator. That's the cash flow generator. That's part of. That's not even part of. That's the largest part of their recovery plan for the back half. So super important. Look, we'll see how long the strike lasts, but if they can't get 737s delivered, this back half recovery is in bad shape.
So let me get this straight. You were in the city yesterday. Then there was this huge Bloomberg Intelligence celebrating 15-year party where you all are like struggling to focus. And then somehow you wind up back at home this morning? What is this?
It's been a busy 24 hours. I wish they could have timed the strike differently, but
I definitely thought he'd be showing up very tired, but in the studio. All right, what's the TikTok now? So what's the schedule of events?
Well, I mean, I think, Boeing and the machinists have to get back together at the table and figure out what the machinists want so they can get them back on the job and start delivering airplanes and generating cash, right? The machinists sounded like they were a little bit coy about it too. I heard one of them saying, you know what, as soon as we have a chance, we'll get back together to talk about it or something like that. So sounds like they think they've got a bit of the upper hand, which I think they do. I think, Boeing probably has to go back and look in their pockets and figure out how much more of a pay increase they can give, right? The Spirit Aerosystems folks got a mid-30s pay increase. So I suspect the machinists are looking at that thinking, hey, we probably deserve something close to that. And I think that they want some better guarantees on an airplane. They want to be guaranteed. I think that the next generation 737 is the most important airplane for Boeing. So if the machinist union has sort of longevity in their sights, they want to be building that 737 successor. And they don't want just the commitment to be able to build it to last for the 4 years of this contract, but they want it to last longer, if not forever.
And George, just refresh our memory. Where does Boeing actually make their planes? I know they do it up in Seattle, but do they do it in maybe some areas of the country that are not unionized?
Well, so they do make the 787 in South Carolina, down by Charleston, and that's a non-union plant. So I expect that 787 production will continue. Everything else is made up in the Pacific Northwest from a commercial airplane standpoint. And so 767s, 777s, they're made in Everett, Washington, north of Seattle. And the 737 is made, is final assembled at a single plant in Renton, Washington, which is kind of southeast of Seattle. Those are all union shops. I expect them all to be doing little to no work today. And then, of course, the fuselage comes out of Wichita, which is owned by Spirit Aerosystems, which Boeing is buying, Wichita, Kansas. But again, they had a strike earlier this year, got mid-30s pay increase, and they should be continuing to work for a while.
So I guess then the question becomes how long? Now, I know we talked about that yesterday, and you're like, look, it can't go on more than like 2 weeks. One analyst was mentioning 50 days was what they were kind of looking at, which is a significant cash burn for Boeing. What's your best guess?
Yeah, I mean, I think there's a lot of people out there saying 50 days because that's the average strike, blah, blah, blah. I just don't, I don't subscribe to that being the right logic here. I'm saying a couple of weeks because I think Boeing really needs these workers back on the job. There is no substitute for these workers, period. And so I think they're got to go engage the union intently and figure out what it's going to take to put them back, back on the job. I mean, we think, look, our analysis was that it would cost an extra $1 billion a year or something like that for wages, right around there at the 25% increase. That would probably trim Boeing commercial margins 170, 200 basis points. Do you like that? No, but it's not the end of the world, right? Back pre-pandemic, this was a company that was making 13%-ish margins in that business, 10 to 13. So can you bear that and be profitable? You can. Can you bear more? You can. So I think that means that Boeing has the leeway. They got to get to building airplanes in volume again. So they got to engage the union and get it done. That's why I'm saying I think less than a couple of weeks. I think they got to get it done.
Hey, George, I mean, I know in the past you talked to us about, the labor shortages in the aerospace industry. Where are we where is the industry in terms of getting past that? Is that still a challenge, getting good folks in the factory floors?
I think it's totally still a challenge, right? And so we saw a pretty decent turnover in the aerospace workers, coming out of the pandemic. I think some of them watched their industry looked like the collapse, right? Air travel went to zero for a couple of quarters or almost zero. So, demand for airplanes, people looked at it and thought, hey, the industry I'm in is horrible. And if you were, I think, near retirement age, you said, let's cash it in and move to Jacksonville, Florida, or something like that, right? So it's hard to get those folks back to the line from Jacksonville. And the backfill, part of the backfill challenge is the backfill came out of some of their suppliers. So they kind of hurt their own ecosystem as they pulled some of the backfill in, and they're in the middle of training that. We even heard CEO Calhoun say, the old CEO Calhoun say, I think at one of his congressional testimonies, he talked about people coming in the door having experience bending metal and working with their hands. And I think he said something like, in the old days, and this isn't exactly right, but it's close, maybe 75% of the people that came to the door had experience working with their hands, metalworking. Now 25%. So they're in the middle of trying to train that next generation of aerospace workers, and the supply chain is still trying to backfill. I think it's been getting better, but that training and backfill is still going on.
All right. Hey, George, we appreciate it. George Ferguson, Bloomberg Intelligence Senior Aerospace, Defense, and Airlines Analyst. Great stuff. Good to see you there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
I'm Alix alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance, economics through the lens of our Bloomberg Intelligence folks. They cover 2,000 companies and 130 industries worldwide. They're a little tired today. They had a 15-year anniversary party yesterday, so,
we cut it loose a little bit.
Yeah. I mean, Paul got some sleep, but the other guys, I'm not sure. All right, but we want to go outside of Bloomberg Intelligence now for a look on how to market is positioned into the Fed. Haghbin is head of solutions and multi-asset strategies over at Invesco, and he joins us now. What is the setup like in terms of asset allocation headed into Wednesday?
Well, Alix, thanks for having me. Nice to be here with you and Paul. I think, we are continuing to maintain a bit of a defensive posture, and we have been defensive for about a couple of months now. And really, this is around what we're seeing in economic growth expectations, both from the market and from the data. We are very benchmark aware, so I think that underweight isn't something that's significant at this point, just given how the economy has been incredibly resilient and the market has been incredibly resilient. But what we're seeing in the labor market and what we're seeing with economic growth over the last several quarters is something that we're watching very closely.
Mo, and how about being defensive? What does that mean, fixed income versus equities here?
Yeah, so that means we have a little bit of a longer duration profile versus our benchmark. So we're, favoring fixed income over equities. So, and within equities, there's a bit of a tilt towards more defensive sectors. So think healthcare, consumer staples, information technology. These are the areas that are a bit more defensive. These are companies that are higher quality and lower volatility, generally cash flow rich, and can weather an economic downturn or a slowdown in growth.
So does that mean that you think that the bond market, if we look at the equity in the bond market as being on different pages, in that we're making like another run in the S&P here versus the bond bull appears to be very sticky, does that mean that the economic situation is geared more towards a recession than a soft landing in your view?
I don't think so. I think we're still probably base case soft landing. But what we're thinking about is just in the shorter term period. So from a tactical perspective, just given how far extended the equity markets are, and in our opinion, yields are very attractive at these levels. They have been, although they've come back a little bit. We're kind of extending that duration profile, getting underweight equities slightly relative to our benchmarks. And again, this is all around growth and growth expectations, although we don't necessarily see a recession in the next couple of quarters.
So, Mo, how about on the fixed income side? Are we sitting here in 2-year treasuries at 3.6%, or are we going out there and taking some credit risk? What are we doing there in fixed income?
So in credit, we favor, again, higher quality credit. So, credit spreads continue to be incredibly tight. Relative to equities, I think credit is a very attractive risk-adjusted allocation. But we're probably not right now favoring kind of the lower quality, high yield sectors, and we're taking a bit more of a defensive posture.
That's where the best performance this year in fixed income has been, and by far has been, in U.S. corporate high yield.
Exactly. And I think that's part of the reason that we've gotten a bit defensive. So just to kind of backtrack a little bit, we have been pretty risk on in portfolios for the last several years. Post-COVID, we took a little bit more of an aggressive stance versus our benchmarks. We kind of maintained that stance over the last several years. And now what we're seeing is just that softening of the economic data. We're seeing some softening in the labor markets, and that's kind of what's informing a bit of a defensive posture. But I don't really want to overdo that, right? We're not kind of underweight equities to a significant magnitude. We're not suggesting that people move into cash. It's actually quite the opposite. We're telling investors and clients to get out of cash. We've seen elevated cash balances now for a long time, and the yields on offer, if you extend that duration, seem to be very attractive to us, especially as we're moving into an easing cycle and those short-term rates are going to be coming down.
Yeah, JP Morgan was saying that usually the rate cut cycle needs to get underway more significantly for then the money to move. But you're right. I mean, over $6 trillion ready to roll. Hey, I'm curious as to dollar yen. It has a pretty significant re-rating at this point. I think we're at 140, right? There was some reports on Bloomberg that we're seeing some bullish bets on the yen right now. What's your take on where that currency goes? And is the carry trade unwind situation over?
So from a currency perspective, just kind of consistent with my comments earlier around equities and fixed income, we have a bit more of a defensive posture. So that means overweights in dollar, GBP, euro versus international currencies, especially if you kind of think about the more emerging market currencies. I think right now the defensive posture is probably warranted, just given we're kind of going into election season. September and October tend to be more volatile months for the market overall. And that home country bias, at least for us, is kind of an important factor as we get through the next few months.
In terms of the equity market, where's valuation for you guys? Do you feel like this market is fully valued at this point? How do you guys think about that?
I would say fully valued to maybe a little extended, just given what we've seen year to date. So for us, there's no real concerns around earnings or earnings projections. There has been some revisions that we're taking a close look at, but for now, I would say probably well priced or maybe a little bit extended relative to what we see kind of on offer in other places outside of the U.S. And I think my comments are very much on the U.S. side. And the equity market in the U.S. is pretty concentrated. That's another topic that we're having a lot of conversations on with clients. We expect to see that broadening if the economy continues to be resilient. But if we are going to go into a prolonged downturn or a growth kind of scare, actually the defensive sector should perform better. And I've talked about this a little bit on the show before. In the past, the relationship between equity sectors and rates was really when rates were going up, that was not necessarily a good thing for sectors that had more duration exposure or more interest rate sensitivity. So technology, healthcare, we've kind of seen the opposite of that. So, it's a little bit of a weird dynamic at the moment, but I do think that should renormalize. So what the catalyst needs to be for small cap value stocks to really get going again, I think is, a little bit of a change in the regime and an economy that kind of reaccelerates, because those companies, small cap companies, value companies, they tend to have more operating leverage. They tend to be more geared to the business cycle. And I do think longer term that relationship will still hold.
All right, Mo, thanks a lot. We really appreciate it. Thanks for stopping by. Mo Haghbin joining us there was his call on asset allocation. He's head of solutions and multi-asset strategies over at Invesco.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alongside Paul Sweeney for Bloomberg Intelligence Radio. We're broadcasting to you live from Interactive Broker Studio right here in Midtown Manhattan. I saw that, though, for the Waymo thing, that like a driverless car could like show up even if you didn't order one. That'd be kind of weird, right? And
yeah, I'm not doing that.
Like, I mean, what if you don't want it?
I'd rather get into a car with a perfect stranger. Well, I know nothing about
than no one at all.
Of course,
yeah. Okay. Well, it's an adjustment period for us all. All right. Joining us now is Dan Ives, Managing Director and Senior Equity Analyst at Wedbush Securities. I bet you he's probably bullish on Waymo and would totally get into a driverless car. No worries. Am I right, Dan?
I mean, I've done it.
Yeah,
Look,
okay.
I think end of the decade, I think 20% of rideshare are going to be no drivers.
But isn't it weird that they would show up, you wouldn't have a choice, and it would just be like, here's your driverless car, even if you don't want it?
Yeah, look, there's going to be clearly kinks to work out here, but I mean, and we'll see this at Tesla's Robotaxi Day, but the technology is starting to get to a point where this is no longer sci-fi. I know the next few years, it's something where the monetization is going to be clear. That's why you see that Uber Waymo.
Well, Dan, I should point out that you're in Bangkok. So
Why?
It's like, what time is it? It's like midnight now?
On a Friday?
On a
I'd be
Friday?
out ripping it.
I know. He's a good guy. Dan, we appreciate that, by the way. I'm looking at Adobe. Adobe's down 9%. What was the problem with their earnings yesterday?
I think it's really just the softer guidance. But, I mean, Alex, in our opinion, this is just a transition in that Adobe story. I mean, when you look at AI and use cases, I think they are probably within 3 to 6 months of significantly benefiting from AI. Stock, obviously, is one of the core plays in big tech. But you look at Adobe, obviously a little softness, but then you look at Oracle, which I think is probably even more important to the broader AI story for big tech.
Then what about some of the other, so then how do we distinguish? What's the line item, right? And as an investor, how do you know when to buy that? You might see 3 to 6 months until we get a really big payoff for Adobe. How do you play it?
Yeah, look, that's why we do so much work in the field, because it's trying to figure out the second, third derivatives of AI, who's benefiting in terms of real monetization. That's where you look at, of course, Palantir, Oracle, ServiceNow. I think Salesforce next week, some big announcements at Dreamforce, what they're going to talk about. Now, Adobe may be a little softer. They haven't seen it yet, right? Mm-hmm. So this is really going to be sort of pieces of a puzzle trying to figure out who in software benefits from the second derivative. Clearly, the hyperscale players, and we would argue even cybersecurity, are going to benefit as more workloads move to the cloud.
So, Dan, as soon as I get off the air here and finish up my 27 straight hours of radio, I'm going to go to my Apple Store app, and I'm going to pre-order that Apple.
Oh, this is today? You're doing it today?
I'm going to do it today. Yeah.
Oh, okay.
Already gave me my instructions. Apple 16 Pro, I'm going to spend $1 gajillion. How many people are out there are going to be doing the same thing? How big is this new phone?
Well, first off, I mean, I think it is huge. The Sweeney upgrade.
Yes.
I mean,
no, it's huge. This is the top, or this is the start of the super cycle.
I mean, for years.
Exactly.
For years, the Sweeney upgrade. And I know, but Paul, I mean, I think now it comes down to, it's not just you. There's 300 million iPhones that haven't upgraded in 4+ years. And this is everything we're seeing here in Asia is showing that this is leading to what we believe is going to be an AI-driven super cycle. And I think we'll see this with pre-orders and obviously go into the next week. But I think demand's going to be pretty robust here. Street, I think, still underestimating what this is going to be about.
Okay, but are people in China really buying into that super cycle? I know Asia is bigger than just China, but can we have a super cycle without a super strong China demand for the iPhone?
Yeah, so it's a great point. You cannot have a super cycle without growth in China. To that point, you have 100 million iPhones in China that are in that window of an upgrade opportunity. And everything we're seeing, that actually China, you will now start to see moderate to significant growth in the region from iPhone 16 over, call it the next year. And that's huge for Apple. I mean, that goes from a headwind to a tailwind, which is really key to this whole sum of the parts story as it plays out, and they monetize China front and center.
So, folks, when technology analysts like Dan Ives go to Asia, it's not just to see their clients. The big reason is to do what they call channel checks. Since much of global tech, hardware, software comes out of that part of the world, you get a good sense of kind of who's making this stuff, who's buying this stuff, who's selling this stuff. So, Dan Ives, what's kind of the vibe you're getting from your channel checks there in Asia these days?
Yeah, I mean, look, across Taiwan and I think just across Asia, demand is not slowing. I mean, it's accelerating in terms of broader when we look at from a chip perspective in AI, which I think is very, very important. I mean, Jensen talked about it this week. Demand's outstripping supply. We think 12 to 15x. And wow. That is the most important thing, is the use cases, whether it's Oracle or Palantir, that will ultimately be the drivers. But enterprises, we're talking about $1 trillion of CapEx that ultimately is coming to tech over the next 3 to 4 years.
What is that what you make of the NVIDIA rally the last 5 days? Like, how do you understand that structural shift and that thesis versus the daily swings of some of the biggest players where seemingly they become more important than central banks some days and drag up the broader equity market? And I can't find a headline on that.
Look, I think that was a confluence of things, from the watch parties to technicals to just coming into September and obviously the macro sell-off tech front and center. But I think, look, anyone that's doing checks in tech, you're not coming back in any way negative on NVIDIA. I mean, it is actually getting more and more incremental, not just for NVIDIA chips, and I think broader the AI revolution. So we're going to have these ebbs and flows, but I continue to believe this will be a tech market that ultimately rallies into year end, because I think it all comes down to fundamentals. And macro's going to do what macro's going to do, but we are not seeing any. So it is an acceleration clearly that we're seeing over the last few weeks.
All right, Dan, thanks so much for joining us there. As always, appreciate it. Managing Director, Senior Equity Analyst for Wedbush Securities. He's Bangkok, Thailand. Go out and get into some trouble. That's an order. So Dan Ives doing it for us again there. Bullish, seeing some channel checks there in Asia suggesting that the demand continues to be there, not just for, I guess, AI chips, but just for, tech in general.
I feel like he's been in Asia for like a month. The last three times I've talked to him, he's been there every time.
4 or 5 times a year, I think.
Oh, yeah. But what I think it's interesting, like we can always joke about Dan Ives being the bullish guy on tech for sure, but it's so interesting to get that take on the structural shift versus a cyclical market and sort of understanding how the cyclicality makes sense when we're all transitioning to a different kind of world. And we can see that in lots of other sectors as well. Obviously, energy is one that I'm going to be paying attention to, but cars with EVs and the structural issues with that. So it's kind of fun.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
All right, what are we doing here with these markets? That's a lot of folks are trying to figure out as they think about next week when we get the Federal Reserve giving us their thoughts on earnings. Shana Sissel joins us. She's president and CEO of Banríon Capital Management, joining us from Chicago via Zoom. Shana, thanks so much for joining us here. We've had a whole slew of economic data really over the past couple of weeks. You put it all together, and it seems like the market is getting ready for the Fed to begin cutting rates. How are you guys positioning kind of your portfolio, and what are you telling your clients?
Well, as much as I love to be a contrarian, I am in complete alignment with market sentiment and that the Fed will cut at this meeting. Chairman Powell has been very transparent, and in his remarks at Jackson Hole, he was very clear that it was time to make a pivot from their previous roadmap to make changes, and cuts were part of that change. So I agree with the market. I think where the debate comes in is how big that rate cut will be. And as you noted earlier, the market probability for a 50 basis point cut is actually rising. And I'm not sure I understand what is driving this belief that the Fed will cut 50 basis points. They've been super cautious. And I just can't imagine cutting 50 basis points without seeing something in the economic growth activity or in the U.S. economy that warrants that kind of what I think would be kind of a knee-jerk reaction. So we're telling clients, to prepare for a loosening cycle. The Fed is obviously loosening policy, and we want to take advantage of that, which in an economy which is fairly stable means that it's a risk-on environment.
So let's go back to what happened in NVIDIA in the last 5 days, right? I mentioned this yesterday. Charlie Mangala over at Nomura said that NVIDIA was basically the central banker of power. That, we can look at the Fed, but it was NVIDIA and the FOMO that kind of gripped the market that has really propelled the S&P higher this week. What matters more for you and your asset allocation? Is it what's happening with NVIDIA stock or what Jay Powell says on Wednesday?
what Jay Powell says on Wednesday.
Oh man, I was really hoping you'd say NVIDIA. You're killing me.
Sorry, I know. I love NVIDIA. I do. But as much as we want to pretend it's a proxy for the economy, and it is to some extent, we should not be basing our portfolio management decisions on the technical trends of a single stock, especially one which is kind of, shrinking in terms of its growth potential. It's an amazing company. It's growing, triple digits, but it's growing at a slower rate than it was a year ago. And that is reflective of what I think the economy is doing. But the Fed's policy is, at the end of the day, what drives the underlying market liquidity and the underlying opportunity for investors in banks or whatever to access capital. So, NVIDIA is great. And control access to capital.
So I guess just looking at the equity markets in general, give us your thoughts on valuation here these days. A lot of folks feel like it's stretched. A lot of folks will say, yeah, but if you pull out some of those big tech names, not so much so. How do you guys look at it?
So I learned at Fidelity, and this is super basic, but I think it's actually a really great tool for people out there who just want to do like quick math in their head. But I learned the rule of 20 during my days at Fidelity. So that is taking the PE of the market and adding in the inflation number and then looking at it on a historical basis. And the general consensus is if it was valuations were above 20, it was stretched. And if it was below 20, it was attractive. And so we're well above 20. Yes, some of that has to do with tech stocks and how much they are kind of weighing on the market. But I think even in the equal weight indexes, we are above that 20 number. And so there's definitely opportunities in the market, but it feels like we're a little frothy here. I don't think we're super expensive by any stretch of the imagination. But I do think that I wouldn't call the market cheap.
Favorite pick right now?
She
hates all my
right
questions
now,
today.
I really like Apple.
Okay, why?
So the stock got beaten up, and then they had their iPhone event last week, which was sort of like anticlimactic. So the stock has been kind of, not doing much for a while. Valuation-wise, it's attractive when you compare it to the rest of the Mag 7. And I think that overall, they're doing the right things to maintain market share. And I think that there's the potential for them to take market share in the future. So, from that standpoint, I think Apple has the ability to grow their global footprint. And people like the ecosystem. I'm definitely one of those people. And the stock is relatively attractive on a valuation basis, whereas you look at something like an NVIDIA or one of the other names in the Mag 7, and they don't look quite as attractive on a valuation basis.
Paul scrolling on his old iPhone, ready to buy the new iPhone very soon,
yes.
As in like in 45 minutes time.
Exactly.
All right, Shana, thanks a lot. Really appreciate it. Shana Sissel, President, CEO of Banríon Capital Management, joining us there. Thank you very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
This is Bloomberg Intelligence Radio. We bring you all the top news in business and finance, economics from our beautiful world headquarters right here in Midtown Manhattan. There's a really interesting Big Take story today that everyone should read. You can find it, Bloomberg Big Take story about college football players facing an ugly truth about payment details. You can read the story on Bloomberg and at Bloomberg.com/Big Take. But we're lucky to have Peter Robison here. He's an investigations reporter here at Bloomberg News, part of this story. I thought college football players got their own money now, and that was awesome, and that was it. What's going on?
That's exactly what the popular belief is, and that's why my colleague Noah Buhire and I wanted to look into this, because if you are a casual fan and you hear about these deals apparently worth millions for college football players, you think, well, that problem of the players being exploited while the coaches and the administrators make millions has been fixed. But we took a really deep dive into these contracts, and they're at most of the big time football schools, they're controlled by booster groups, which are essentially wealthy individuals, think the richest car dealer in town. And they're in charge of the deal. They write the contracts. And we actually got our hands on at least 3 of these contracts. And in many cases, according to other people we've talked to as well, these come with broad termination rights, which wouldn't be seen in virtually any other industry. But there's one contract we looked at that said it can be terminated at any time for any reason. So players are essentially still being exploited. It's a version of the black market that's existed in college football for a long time.
Peter, by and large, do these student athletes have representation, whether it's legal or an agent, to kind of protect them here?
It's really catch as catch can, and it depends on the player. And you can imagine for someone who's a teenager, these are 17, 18, 19-year-old kids. They're entering this world for the first time, and a majority of the players in Division I schools are black, many from disadvantaged backgrounds, and so you have these situations where players are not aware of their options, they're not apprised of their options, and because it's a third-party relationship between the university and these donor groups, there's really no one looking out for their interests. There's no one accountable when one of these deals goes wrong.
So how do we fix this?
Many people I've talked to look at the pro leagues and they say what's happening in college football is a professionalization of college football. And in the pro leagues, the players collectively bargain. In the pro leagues, the NFL Players Association, for instance, requires that the contracts be disclosed to them so that all the players know what all the terms are. It's a very transparent, very fair market. And so many of the people I talked to said that that's exactly what should happen in college sport, at least in big time college football, where there are billions being made.
These booster groups now have a new moniker. They're called collectives, which I think is kind of spooky in and of themselves. And we actually know some people that are parts of collectives of their university. And those are the ones that are, who's monitoring or regulating these collectives, if anyone?
Well, that's exactly the question, and yeah, you're right. The word collective hasn't been in popular use since the 1930s Soviet Union, but because of the way that NCAA has lost repeated antitrust suits and has lost the ability to enforce really any rules over college football, there is no one monitoring this. Congress has looked at this, has held a dozen hearings since 2020. But there just hasn't been the momentum for bipartisan legislation that might put some guardrails in this market.
What about the whole, and forgive my complete lack of knowledge, the likeness thing, like image of likeness? What's that called? What's the
NIL?
NIL.
And that's what we're talking about.
Yeah.
Okay.
If you follow college sports, you
clearly I don't, but go ahead.
I'm saying, that name, image, likeness has become, it's amazing how rapidly it's become part of the daily coverage in sports, and it gives people the impression that athletes are signing endorsement deals with Nike, with Adidas, that they're out there on social media. But the interesting thing about college football is that although there isn't really good statistics about this, the best statistics we have show that about 80% of these NIL deals are actually from these collectives. So people have the impression that Adidas and Nike are pouring money into the sport, into especially specific players. But at least as far as what the players are making individually, that's not the case. It's still these collectives that are in charge.
And Peter, is this a case so far with the big stars get most of the money, and if you're in like an Olympic sport, you're not getting much, if anything?
Yeah, it really depends on the individual athlete, and like the rest of the economy, it's a star system. We looked closely at these contracts and talked to agents, and what's happening is that if you are a star with leverage, you can make a starter at a power conference school in football can make in the six figures every year. But if you're not a starter, you're on a month-to-month contract. If you don't perform well, or if you're injured, that money goes away. So it's just not a guarantee, especially in the same way that coaches have. Coaches even assistant coaches in college football can make 400,000, even up to 2 million and up.
Wow. All right, Peter, thanks a lot. We really appreciate it. It was a really great piece, everybody. Peter Robison, investigations reporter, joining us from Seattle, Washington. Again, you can find that story on the Bloomberg and at Bloomberg.com/Big Take, talking about college football players facing an ugly truth about how they actually get paid for stuff.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.